Hi there, my name is Khalstian and I'm the founder of Egg Capital, where we look for market-beating stocks for the long run. You may remember from the previous episode of my tech series, or you may be new here, that in order to find these companies, we will analyze the 5 following factors to form an opinion on whether a stock is undervalued, fair valued, or overvalued. We will look at high returns on capital, strong growth, healthy financials, an undervaluation, and a sustainable moat. Today, I will be analyzing Microsoft. But before we do, please take a moment to hit that like button, and if you're new here, subscribe to my channel so you never miss out on any future updates and valuable content. Microsoft is the tech giant behind software products like Windows and Microsoft Office, which is now sold as a SaaS solution called Microsoft 365. Windows is currently the most used computer operating system in the world, with a staggering market share of 72%. And Microsoft 365 is the most used productivity software in the world, with 400 million users worldwide. Microsoft has many more revenue streams though, such as cloud services through Azure, LinkedIn, and gaming revenues, which come mainly from Xbox and the acquisition of gaming company Activision Blizzard. Microsoft is also investing heavily in AI, and more specifically in improving Copilot, which is Microsoft's AI tool that can be used together with Microsoft 365 apps such as Word or Excel. Now let's break Microsoft down into our 5 key factors. For the first factor, we are looking for companies with high returns on capital deployed, preferably a return on invested capital and return on equity ratio that is higher than 15%, as this gives a strong indication of financial efficiency and future profitability. Microsoft ticks the box on this front with a 5-year average return on invested capital ratio of 28.5% and return on equity ratio of 42.4%, which is a strong indicator of effective and disciplined management. However, it is worth noting that the return on invested capital and return on equity have been decreasing in the past 3 years. This appears to be caused by heavy capital expenditures in AI, which pressure profit margins, so definitely something to keep an eye on. Next to that, we are looking for companies that are able to grow earnings. Microsoft is showing strong growth with revenues of the last 5 years growing with a compounded annual growth rate of 16.5% and a compounded annual growth rate for earnings per share of 22% for the past 5 years. This results in an impressive growth of earnings per share from $5.8 in 2019 to $12.1 for fiscal year ending 2024. The question is whether Microsoft will be able to continue this trend with heavy capital expenditures in AI and cloud solutions. Microsoft's AI tool Copilot is enabling users to enhance their creativity, productivity, and skills. Based on my reasoning, even with just 1 hour per week in time savings, the tool would pay for itself and more, as the license costs $30 per user per month. Not adopting by companies comes with the risk of employees turning to other AI tools, which could potentially result in data leakage. I think there's also fear of missing out for companies, because if a competitor is using Copilot and achieving positive results, you don't want to miss out on that as management. The flip side is that some companies might have fears about implementing AI tools, as confidential information could be used to strengthen the data model and come in hands of competitors. This is a general fear around AI and could be avoided by providing trainings to employees on how they should use AI tools, such as Copilot. My view is that this is a really strong growth lever for Microsoft, as most companies are already using Microsoft 365. And the cross-sell for Copilot could have immense potential for future growth and earnings, but more on this later. Now for the third factor, we look at healthy financials. Microsoft has a total debt of $96.8 billion and $78.4 billion in cash and short-term investments, which is at an acceptable level as Microsoft made $90.5 billion in net income for fiscal year ending 2024 and would not have any difficulty in paying down its debt. What is interesting though is that Microsoft's debt has increased with roughly 18 billion in fiscal year ending 2024 compared to 2023, and their cash and short-term investments have decreased with 33 billion over the same period. Preferably, we would like to see this the other way around, with debt decreasing and cash increasing, which shows that the company is generating strong cash flows and has enough cash to invest from organic growth instead of financing. Again, one to keep in mind given Microsoft's heavy investments in AI. Now, for the fourth factor, we look for companies that are undervalued. Historically, Microsoft, like most FANG stocks, tends to be priced at a premium based on healthy growth prospects for the future. With a current price to earnings ratio of 35, we can say it is overvalued compared to the broader market with a PE ratio of 30 for the S&P 500, which consists of the 500 largest US firms. Using the rule of thumb that I've learned from the super investor Peter Lynch, when earnings growth is higher than the price to earnings ratio, then this is a good indicator that the stock is undervalued. This does not appear to be the case, as the compounded annual growth rate in earnings per share for Microsoft is 22% compared to the PE ratio of 35. Again, Microsoft's Copilot is a growth lever that could improve earnings significantly in the future. But the question is whether it is enough to justify paying 35 times earnings per share to acquire one stock. We can do a rough calculation for this. Microsoft 365 currently has approximately 400 million users worldwide. Say 70% of those are business users, which will most likely be the first adopters given a pricing of $30 per month. Taking then an adoption rate of 20% of all users would result in an additional annual revenue for Microsoft of roughly $29 billion. The next question would be what the margins are for this business. If we would take Microsoft's current net profit margin of 35%, this would result in additional annual net income of roughly $10 billion. This is an added 10% taking 2024 earnings. In my view, this is an exciting prospect for the future, as I believe these subscriptions would be very sticky and Microsoft could continue to keep on raising prices in the future and further growing its profits. A strong determinant of future growth is the moat, which is the ability of a business to maintain its competitive advantages over its competitors in order to protect its long-term profits and market share. Key competitors in cloud solutions include Amazon with AWS and Alphabet with Google Cloud. While Alphabet is also a significant competitor in AI tools alongside other players such as Meta, IBM, and NVIDIA. Microsoft has a strong moat with its dominance in productivity tools through Microsoft 365 in combination with its cloud services through Azure. Microsoft 365 will, in my view, keep on growing as new and existing customers continue purchasing these tools with no comparable products currently on the market. When you add Copilot to the solution, which from a business perspective appears to be a no-brainer due to productivity savings mentioned earlier, I see continued growth and diversification for Microsoft. However, there are some risks to the moat of Microsoft, as they are spending tens of billions of dollars to set up the AI infrastructure for Copilot. Full year 2024 capital expenditures was up 75% year on year to $44 billion, of which $19 billion was specifically from cloud and AI related spend. Fun fact, Microsoft's fiscal year ends at 30 June, which is typically 31 December for most firms. Messaging from Microsoft's management is that capital expenditures are increasing on the basis of cloud and AI demand signals, which is bullish But at this point, investors have no concrete information on what Copilot is generating in revenues. Will companies invest in Copilot in the near future or wait until the tool's success is further proven? That is the big question and could create an awkward position for Microsoft as they are investing so aggressively to become the dominant player in AI. On a side note, Microsoft's management team pointed out that 40% of capital expenditures for AI infrastructure is spent on land for the data centers, which is a long-term asset, and the remainder 60% is the kit. In my view, investors will need to decide whether the high capital expenditures will be returned to investors over time or view high capital expenditures as a bullish signal that there's too much demand, with future AI revenues well exceeding the capital expenditures to build the infrastructure. Now, before we conclude on Microsoft, you may have spotted in the charts that I've shown in my video that these were created with the help of FinChat. If you want to take your investment analysis to the next level, then click on the link in the description box below to receive a 15% discount for FinChat and unlock powerful tools to make smarter investment decisions. I'm advertising this tool as it's a reliable and very intuitive product, and I've been using it for years. To conclude, in my view, Microsoft is fair valued based on the 5 key factors that we discussed earlier. It is a robust tech firm with high returns on capital deployed, but the returns are decreasing compared to capital deployed due to increased spending in AI, which is something that needs to be monitored closely. Earnings are growing strong, with the largest source of profits coming from Microsoft 365, cloud solutions, and Windows licensing, which in my view will keep on growing for the foreseeable future. As cloud demand is expected to keep on growing and Microsoft 365 and Windows are functioning as near monopolies. From a valuation perspective, the stock seems to be overvalued based on the current valuation, which is looking backwards at 2024 financials. However, when you factor in the outstanding growth prospects from cloud solutions and AI, as Microsoft is investing heavily to become the dominant player in these fields, the premium paid today might be justified for future growth. Microsoft has a very strong moat as their offerings are so well integrated. As mentioned earlier, 72% of all computers run on Windows, and almost 400 million users worldwide use Microsoft 365. Azure provides seamless integration with these existing tools and systems, making it easier for businesses to move their operations to the cloud whilst maintaining consistency. To decide afterwards on adding Copilot feels very natural, as it integrates smoothly with Office apps and Azure, as Copilot leverages Azure's AI capabilities through the underlying cloud infrastructure. Please let me know in the comments below what your view is on the valuation of Microsoft, or if you would like me to analyze another company. Thank you for watching and see you next time.